Welcome back to my channel, Balance Sheets Matter. Today we're going to be looking at Alphabet Inc., more commonly known as Google. So we're going to be doing a Google stock analysis. But before we get into the analysis, make sure to subscribe to my channel, Balance Sheets Matter. I do individual stock analysis videos, so if you want to get ideas on potential stocks to buy or value traps to avoid, make sure to subscribe to my channel. And if you do want me to look at a stock, leave it in the comments below. But without that, let's get into the stock analysis. So let's first take a look at some of these higher level things at the Guru Focus front page here. Like to always take a look at the Guru Focus value band. When companies do have consistent historic basically revenue and growth, it can be fairly accurate, and it's saying Google is potentially a little bit fairly valued right now, maybe on a slight side of undervalued. When I'm recording this video, this is right after earnings. They are down 6%, so it is going to be a little bit cheaper than maybe when I'm actually doing this video when it's released. But that's just something to keep in mind. I think, for Google and the financials, which I already know, this could be somewhat accurate. And we basically can see they have a 29.41 PE. May seem a little bit high, but their forward PE is only 21.14. So that is quite a lot lower, meaning EPS is estimated to be quite a lot higher. So we dive into their financials here, and first we're going to look at the revenue growth trend, and they've had a great revenue growth trend over time, and analysts are estimating to continue growing in the future. And for the last 10 years, it's been 20% growth per year, with EPS also growing at 20%. And I usually don't do this, but I'll just jump into my stock chart here right away, and I got the little trend going here, and this is about a 20% trend here. And Google is actually, stock price has been increasing with the real actual growth. So I wouldn't say Google, just even from that perspective, is very overvalued, especially with a forward PE of only 21. So I like to look at return on invested capital over weighted average cost of capital, although not super relevant for Google, since your weighted average cost of capital is really only relevant if you have to take out debt through either issuing shares or taking out debt, basically. But the return on invested capital is much higher. They're currently sitting at 27%. A lot of the times they'll hover from as low as 18 here up into the mid 30s to 35, even 45 in the past. So about 27 is still very good, which weighted average cost of capital is usually being 10% right now, 11 or lower. We go down, we look at the revenue trend. As I said before, revenue has just been growing like mad. There was a really big boost from 2020 to 2021 where they grew 182 billion in revenue, that's billion, to 257. So this company, very large already, and they're almost accelerating growth. But then in 2022, there was a bit of a slowdown, kind of averaging that out, and I think that's what's been basically happening, as the last rolling 12 months is only at $289 billion. So the revenue could be slowing. This could just be because of they're digesting those gains from the big boost from 2020 to 2021. It also could be because of potentially a little bit of economic slowness. As many know, basically, as I've said before, the yield curve is inverted. The Fed's basically been hiking rates to try to put the economy into basically a little recession. Hard landing, soft landing, it's still a recession. And Google, I will tell you, is a sensitive stock to recessions. I actually run my own business where I do a lot of Google ads, and I can tell you, when you need to, you can very easily scale back Google ads very quickly, and you can very easily increase them as well. So if there is slowness in the economy and people aren't buying as much, you can expect advertisers will dial back their ads quite a bit. And because of the great accurate tracking you can do with Google, you can tell exactly how your ad's performing, and this can happen very quickly. But we can basically see gross margins have drifted down a little bit over time, but they're stabilizing around 55% since 2018, 2019. Normally I would say this could be potential loss of competitive moat, but they have had a big product change of adding in the Android phones and other physical Google products like the doorbells and the tablets and the Google Chromecast, all products I love too. So I wouldn't say that they're losing any competitive mode. Google's the biggest search engine there is, and it's right now quite dominant. They're in AI, they're have their self-driving cars, they're in a lot of other verticals as well. So there's a lot of potential growth opportunity, and even just with their ad business, there's obviously great opportunity with that. Is it's going to keep increasing probably, and at least with inflation. But we can basically see operating margins right now just around under 26%. Pretty normal, historically accurate. So that's kind of been where it's been, and their interest income has just been going up and up over the years, with almost $3 billion of interest income in the last year there. Well, they do have 314 million of interest expense. They have so much cash on their balance sheet. They're earning quite a lot of money off that. And some people say, well, why don't they return this to the shareholders? Well, I think it's kind of good Google holds on to this. It potentially prepares them for rocky times. And if they really want to do a big acquisition, they have a lot of money sitting there. They don't need to take that. They don't need to issue shares for those reasons. So we go down a little bit more. You can basically see net income been going great over time, though we did have that big peak in 2021, 76 billion, down to 60 billion now. But if you compare that to 2020, it was 40 billion, it's gone up to 60 billion. That's not too shabby. 50% growth over 3.5 years or 2.5 years. That's pretty good. And EPS has been increasing in line with that. Well, we can see the overall shares outstanding basically does fluctuate. They actually, where they do seem, it looks like they do buy back a lot of shares. This doesn't actually reduce their share count that much. As you can see back here, it was, say 2014, 13.7 billion or million shares, 13.7 billion, whatever it is there, goes up to 14. It's coming back down a little bit. So you have to remember that Google, because they are a tech company, they actually do end up doing a lot of stock-based compensation. So even though you're hearing about all these share buybacks, they really haven't significantly reduced their share count at all over time, which is a little bit concerning, I would say. But you kind of just do have to realize, even though Google is buying back shares, they aren't really increasing your ownership of the company by any significant amount. Maybe it'll happen more in the future, we'll have to see. But we're going to see on their balance sheet here, basically great total current assets, 168, almost $169 billion, and with only current liabilities of $77 billion. So they have a whack more basically cash. You can see cash and cash equivalents sitting at almost 120 billion. That's why they're earning all their interest expense. So very strong balance sheet so far. Total assets sitting at $383 billion. And goodwill's actually very, very low at only $29 billion. So where they do acquisitions over time, this isn't being a big thing contributing to their balance sheet. But that's a lot of assets on their balance sheet. They do have servers. They do have, offices and basically campuses. So they have a lot of investments. And basically total liabilities, only $115 billion. Leaving them with total stockholder equity of $267 billion. You even take out all the goodwill, you're still sitting at basically $237 billion. Although we need to see the cash flows to see if all these assets are kind of real, because assets do depreciate over time, and sometimes companies don't depreciate them at the real rates they're being replaced. Basically, you can see cash flow from depreciation has been going up over time because they're always expanding over time. And the one thing you can see is the purchase of plant, property, and equipment is being historically about double the rate of whatever they basically are depreciating. So if they're depreciating, $16 billion in depreciation one year, they're spending $32 billion in replacement. And that goes back and back and back pretty much for the entire history of the company. But does this mean that they're having to replace more purchase of plant, property, and equipment than they're actually depreciating? I would say not necessarily, because of the fast growth rate they have. They're basically, you can look at it that, in the last year here, well, they did depreciate about 16 billion, which probably, you would then, in a nice simple world, you would say 16 billion of the purchase of plant, property, and equipment is replacement. Well, 16 billion is also going towards growth. And this kind of makes sense at the rate they have been increasing at that 20% per year. So this isn't something I would be concerned about now, but it is just something to keep in mind to see what this number is, what they are kind of repurchasing of plant, property, and equipment if they ever were to start decelerating in growth. Although I don't see a concern now. The more thing I think people need to draw their attention to is the very high stock-based compensation. You can see in the last 12 months, $21 billion of stock-based compensation. And it's been a very big thing of Google. So, this can be very deceiving when people start looking at the cash flow, because they see this really high cash flow from operations, and even though they take off the purchase of plant, property, and equipment, because of all the stock-based compensation, I think it kind of makes the free cash flow method not a very accurate way to look at Google. Just look at EPS. It's a much better way for a company like Google to arrive for a value added. And you can see they do these little acquisitions over time where, $6 billion and $2 billion or $4 billion may be bigger for other companies. For Google, this is a drop in the bucket. This is far less than what they just spend on investing in themselves. So this is just something they do. They pick up, little other brands or little other additions, and then they're really growing them. But they're not really, I would say, an acquisition company or really in that stage, because these aren't really a very significant part of their business other than doing small strategic acquisitions. And you can see basically, well, in 2017, 2018, for whatever reason, little bit of repurchase of stock for whatever issuance of stock for whatever reason. They typically never are issuing stock, and they're typically repurchasing a lot of stock. Although again, you need to balance this out against how much they're basically issuing in stock-based compensations. Although they really have upped this in the last year. And in the last year, this is actually quite a bit of $60 billion they've repurchased in stock. So now we actually probably should see the share count starting to decrease quite a bit going forward in the future if they keep this up. And maybe they are going to reduce down that cash pile a little bit. And you can see again, like I said, free cash flow very positive, although because of the stock-based compensation, you got to weigh that out a little bit because they really should be purchasing back at least whatever they're they're need to repurchase whatever they're issuing in stock. So let's figure out a little bit of a relative valuation here for Google or Alphabet stock, whatever you like to refer it as. So I like to first look at the revenue with estimate and the EPS with estimate to kind of see what the trend going forward based on what analyst estimates are. And you can see it's quite good. They're expecting Google to be growing at the revenue at least at about a 10% pace and the EPS at even a higher pace, because probably with those extra share repurchases, that's going to help drive that. But from at least from the revenue perspective, you could see them decelerating for less than 20% growth per year going in the future. At this size, 15 would still be very, very good for them. But let's pop up the price to sales ratio. That's sometimes one of the better ways to get relative stock analysis. And you can see right now they're sitting at 6.3, but after their drop from the earnings, they might be a little bit lower. But you look historically, 6.3 again, it looks actually fairly valued if we compare kind of from 2009 going forward. And well, the price to sales basically analysis is really only good if they have a consistent net margin. I pop up the net margin where it does fluctuate a little bit. It has been very stable, so this is actually a pretty accurate way probably to look at Google. So I really look at Google of that. It's a stock that everybody should really consider owning if you have an individual stock portfolio. If you do just buy ETFs like the S&P 500, well, you already own a nice chunk of it. But if you do want to buy it, I always like trying to buy it on the dips, buy it when it's a little bit more attractively priced. And you can see basically that might be when it kind of gets to what's that, a price to sales ratio of say 5.5 or below. That's kind of when Google starts getting more attractive. Let's also just take a look at the price to PE ratio, because Google has been pretty consistent with the earnings. And you can see PE ratio too kind of fluctuates, from sometimes in even the high teens. Definitely at the end of 2022, it was trading under 20p, and that was a very good time to buy it. Gets a little bit higher, it gets high 20s or into the 30s, and that might be the best time to buy it. So you can look at the PE, you can look at the price to sales. I think price to sales is a little bit better to look at. Over a long-term stock chart here, this is kind of the technicals, but also it's been going with the fundamental trend as well. And right now fairly valued, so therefore not the most attractive place to purchase it. Although if it does continue with this trend, that would be a 20% compounding return per year. But it is much better if you can wait for a dip. As you can see, a lot of the times it does at least get to the blue. I think that's the 50-week moving average. So that might be a target for it to come down to here. It can maybe come down to 120. And if you don't own it, maybe that's the time you want to start looking at it. Or if it really gets to these lower levels here, this is always a great time to buy it. I think the last time I bought a lot of Google was back on these dips right here. And I think actually where I have my cost average is at $54 a share, so somewhere around there. And this isn't the company I look at trading, just kind of buy and hold, because the thing is, if it does get overvalued, it doesn't mean it has to go down. It can just go sideways for a while. And from the financials, you can see Google's very good. There's nothing really wrong with it. It's should probably be a staple of everyone's portfolio. You just need to find a good price to get an entry on it and buy it. And maybe with a drop, maybe we're going to be getting a little dip down. It's going to come down here, and people are going to get another opportunity to get in this great stock, Google. But I hope you like my stock analysis. Remember to subscribe to my channel, like the video, and I will see you in the next stock analysis.